Hey guys, welcome back to the channel. In today's video, I'm going to show you how to sell a put contract using Charles Schwab's web platform. In the event you're not familiar with how to trade options, check out my video series. I'll leave the playlist down below so you can watch all the videos. But in this video, I'm assuming you know what selling a put contract does. And this is what my brokerage account looks like with Charles Schwab. And in today's video, we're going to sell a put contract on AT&T. Now, if you're selling a put contract, this is because you're bullish on the stock. You ideally don't want to be assigned. You don't want to have the contract exercised and then buy 100 shares of the stock. However, when selling put contracts, you should feel comfortable buying the stock anyways. So ideally, you're bullish. You think that the stock price is going to go up in the near future. But even if it goes down and you're assigned, you don't mind holding the contract anyways. Selling put contracts in a way is win-win. Either you collect the premium and you're paid, or you get assigned the stock at the price you were willing to pay for it anyways. So looking at AT&T's stock price, it's currently at $28.91, and I honestly would feel fine buying 100 shares of AT&T at a strike price of $28 or $28.50. So that's what I'm going to be looking for today to sell a put contract. Now, it doesn't matter what brokerage account you use. It all is kind of overwhelming when you first start buying options. So there's a couple things I'm going to point out to you first. First, on Charles Schwab at least, you'll notice it has account value, $25,117. That's what my brokerage account is valued at. Cash on hand, $537. When we sell the put contract, my account value won't change unless the value of the contract changes. However, I will be paid once I sell the contract. My cash, my uninvested cash will increase by the value of the contract I just sold. So on Charles Schwab, if you want, you can go up to trade and then you can go down to options. Otherwise, you can scroll down and then AT&T on the right, it'll show you option chains. Now, once again, this is a lot of information, and all we're trying to do today is sell a put, so we're going to switch this to just show the puts. For expiration dates, we want to do the third Friday in March. Now, there are weekly and quarterly contracts. However, the contracts with the most liquidity are always the third Friday of the month. Now, the next third Friday is February 19th. However, I want this to be a 60-day or 2-month contract for AT&T. We'll click continue, and this is what we're looking at. Now, the blue shaded area are contracts in the money. So if the current share price is 28.89, at the strike price of 29, this contract has intrinsic value. So if you were to exercise it, there would be intrinsic value. So the premium you would be paid as the seller goes up the deeper in the money you are. However, I want to buy the closest contract out of the money. I'm bullish. I think the stock price will be going up, but worst case scenario, if it trades sideways for 2 months, it still might not exercise, or I won't lose value. And I don't want to say I'll lose money, but lose value if the contract is exercised. So for the strike price of 28, we're going to go ahead and click on trade. And this is what Schwab's trade ticket looks like. We are going to, once again, it's a put, expiration date March 19th for the strike price of 28, and we are going to sell to open. We're writing this contract and hoping to sell it to somebody willing to buy it. Now, when you look at the bid-ask spread, wow, that's really close. So AT&T is a large company. There's a high volume of contracts trading. The sellers are asking for 79 cents. The buyers are bidding, trying to buy contracts at 78 cents. I'm going to have to fill this at 78. If it's a stock with lower liquidity or not in the S&P, this bid-ask spread will be wider, and you're going to want to do something probably in the middle. If you're fine doing a limit order at the asker's price and you just want to be patient, you probably still could get it filled, but it might not fill that day. So we're going to do the limit order at the mid price, so 0.78. What this means, because each contract is worth 100 shares and I'm paying 78 cents per share, I am going to be paid a premium right now of $78. However, I am agreeing to purchase 100 shares of AT&T on March 19th for $28 a share. And that would only happen if the buyer of the put contract wants to exercise it, wants to sell it to me, and they would only do that if the share price went below $28. So let's go ahead and review the order and execute. Now, something I want you to notice on the review order page is there's the estimated commission of 65 cents. That's not times 100, that's just 65 cents. This goes to the Chicago Board of Options Exchanges to facilitate the contracts being bought and sold between people. So I'm actually only getting paid $77.35. Okay, we're back on my positions page. It actually filled immediately, and you'll notice two things. One, account value didn't change. I was about $25,120, but my cash did change. It was at $537.75. It's now at $616. So I was paid cash, but my account value did not change. Why is that? Well, let's look at the contract and just think about this. So here it is showing up under AT&T. I currently have two other put contracts here. But for AT&T, it tells you first the expiration date, March 19th, the strike price, $28. And for quantity, it shows -1. Why would it be -1? The reason why is because I sold the contract. I created it and then debited it to somebody else to receive the payment. So whoever bought this put contract has a +1 showing currently. Now my cost per share is 78 cents. That's what I did with the limit order. And the price, 0.785. Now immediately after selling the contract for gain loss, you're going to see a negative. And that's because the contract costs 65 cents. It's a very small number. So the market value of this contract is $78.50. My cost share, how much I was paid, is $78. Now, what I want to happen is I want the value of this contract to go down over time. And there's, I guess, three ways that can happen. The first one is theta decay. So just the value of these contracts slowly decays every day until you get to the expiration date. So if everything remains constant, the market value of this contract will continue going down. So if I have to buy to close to exit my position, I would be doing it for a less dollar amount. Now this will go to 0 on the expiration date if it expires out of the money, and then my account value will finally increase. I've already received the cash, but it's figuring out what the contract is debited towards me if I have to buy to close it. So it's currently, for market value of the contract, -$78, and theta decay will cause this to go down. Likewise, if the share price of AT&T goes up, because I bought it because I'm bullish, if the share price goes up, then the intrinsic value of the contract, well, it's already 0. But it'll become more out of the money and therefore less valuable. The third factor that affects the price of an options contract is volatility. So let's say AT&T stock shot up $1 and then went down $2 and then went back to what it was today. Just from that volatility, it would cause the contract to become more valuable, therefore making it look more negative on my side. However, once again, I'm perfectly comfortable holding this contract for 2 months. I'm confident that either AT&T will continue trading sideways or it will go up over the next 2 months. So I'm happy being paid that premium of $78. Last thing that I need to mention to you guys is that with AT&T, with the strike price of 28, if I'm agreeing to buy 100 shares, then I need to have $2,800 in my account to purchase that shares. So my brokerage account is tracking how much obligations I have to actually buy the stock should the contract be exercised. However, you'll notice that for cash, I don't have $2,800. So what's occurring here is I have margin buying power. Because my account value is $25,000, Schwab is giving me an additional $25,000 worth of purchasing power. So that's on margin. Now, normally margin costs you money. There's an interest rate associated with borrowing to buy stock. However, when you sell puts, all that Schwab cares about is that your margin can cover it should the contract be exercised. However, you haven't bought anything yet. So Schwab isn't charging you interest for having the obligation to buy the contract on margin. So if I close out this contract, like I buy it to close so it never gets exercised, once again, Schwab doesn't care as long as all of these put contracts combined are less than my margin buying power of an additional $25,000. Okay guys, in the event you found this video and you're not following my brokerage account challenge, definitely check out that playlist. Once again, I'll include that down below. And if you have any questions about selling put contracts, I'll make future videos with more details of buying and selling option contracts. I'll probably do examples for Vanguard and Fidelity as well, but this is what it looks like in Charles Schwab. Till the next video guys, take care.